Peer Corporation actual overhead for the year was 650,000 with a total of 170,000 direct labor hours worked on the job. So how much total overhead was applied to the peers code job during the year? Use peers code predetermined overhead rate of $4 per direct labor hours. So overhead applied during the period. So here POHR is 4. So 4 multiplied by its actual activity, which is 170,000. Answer is 680,000 that the Pierce Corporation applied on manufacturing overhead. So here, can you see the problem here? The applied overhead that we applied on the basis of 170,000 direct labor hours, the amount is 680,000, but the actual overhead is 650,000. So here the problem is that applied manufacturing overhead is greater than actual manufacturing overhead. So this is a case of over applied manufacturing overhead. So how to solve this? Before that we have a very quick check, and I'm just gonna give you 5 minutes to solve this one and try to find out which is the relevant option here. So the Tiger Incorporation had actual manufacturing overhead of 1,210,000, a predetermined overhead rate of 4 per machine hour. Tiger Incorporation worked 290,000 machine hours during the period. Tiger's manufacturing overhead is, so the answer is you find out the activity according to if they have worked 290,000 machine hours, what would be their applied manufacturing overhead. So applied manufacturing overhead based on actual activity 290,000, and the answer is, let me calculate it first, 4 multiplied by 290,000, 1,160,000. That would be their applied, and the actual is 1,210,000. So it means actual is greater than applied. It means we are under applied. By how much? 50,000. 50,000 came from the difference between applied and the actual one. So the correct answer would be option B. So I have also pasted exercise 3.8 to further strengthen your understanding regarding under and over applied manufacturing overhead problem. So I'm just going to give you 5 minutes to pause the video and read this question thoroughly and try to solve it and then we're going to solve it together. Okay, let's do it together. So the question states that Osborne Manufacturing uses a predetermined overhead rate of 18.20 per direct labor hours. The predetermined overhead rate was based on 12,000 estimated direct labor hours and 218,400 of estimated total manufacturing overhead. So the company incurred actual overhead 215,000 and a total of 11,500 total direct labor hours, right? So we need to find out whether the amount of under-applied or over-applied manufacturing overhead for the period. Now here comes the question. The actual is 215,000, which is based on 11,500 total direct labor hours, but the estimated, that is 18.20 per direct labor hours, it is based on 12,000, right? So what did I tell you, that we need to compare apple to apple? So we need to find out applied or estimated manufacturing overhead based on 11,500. So in that case we need to find out the applied activity based on actual manufacturing hour. So the answer would be, so we multiply 18.20 with the actual activity. The answer is 11,500 multiplied by 18.2. Answer is 209,300. Right? So it means that if they have estimated 11,500 direct labor hours, they would have charged $209,300 or dollar to the estimated manufacturing overhead, but instead they have incurred 215,000 manufacturing overhead. In this case, actual manufacturing overhead is greater than applied, and this is the case of under applied manufacturing overhead, right? So it means the answer is that we are under applied by how much? We just need to less the amount 5,700. So determining the amount, so we just less 209,300 from 215,000. The amount will be 5,700 under applied. So its part 2 is that assume that the entire amount of under applied or over applied overhead is closed out to cost of goods sold. So what would be the effect of under applied or over applied overhead on the company's gross margin for the profit? For the period. So because we charge less amount to the cost of goods sold and we will add, so it means this amount will be added to cost of goods sold. It means the cost will be increased. When cost will be increased, right, the profit would be decreased. So the format for income statement, that sales minus cost of goods sold is equal to gross profit. When cost is increased, gross profit will be decreased. So the end result would be that the gross margin would be decreased.